U.S. producer prices unexpectedly remained unchanged in June as rising costs for goods due to tariffs were offset by a softening in services prices. The Labor Department reported that product price index for the final demand held steady following a 0.3% rise in May, and contrary to economists' forecasts for a 0.2% increase. Over the past year, the index has risen 2.3%, down from 2.7% in May, while consumer prices in June saw gains in tariff-exposed goods. Weakness in sectors like travel and hotel accommodation helped temper overall inflation. The Federal Reserve has reported that U.S. factory output rose slightly in June with a 0.1% increase as stronger aerospace and metals production offset declining auto manufacturing. Industrial production overall grew 0.3% after 2 stagnant months, boosted by a 2.8% surge in utilities output during a nationwide heat wave. However, capacity utilization remains below historical averages at 77.6%, reflecting persistent challenges for manufacturers. While the sector showed 0.8% annual growth, economists caution that Trump's protectionist policies may struggle to revive U.S. industry quickly, given high production costs and global competition. German Finance Minister Lars Klingbeil has stated that the U.S. President Donald Trump's tariffs pose a significant threat to both the American and European economies, calling for a fair deal with the U.S. Klingbeil remarked that Trump's tariffs would result in only losers, speaking during a press conference with his French counterpart Eric Lombard. He emphasized that the threatened 30% tariff on European goods, if implemented, would be a game changer for Europe, potentially devastating transatlantic commerce and forcing a re-evaluation of Europe's export-led economic model. Klingbeil stressed that while Europe seeks a fair resolution, decisive countermeasures would be necessary to protect European jobs and companies if an equitable agreement cannot be reached. President Donald Trump has stated that the United States would pay no tariffs to Indonesia as part of a trade deal, while the Southeast Asian country would pay 19%. He highlighted that trade talks are also going well with India.
Indonesia, I spoke to their really great president, very popular, very strong, smart, and we made the deal. We have full access to Indonesia, everything. As you know, Indonesia is very strong on copper, but we have full access to everything. We will pay no tariffs. So they are giving us access into Indonesia, which we never had. That's probably the biggest part of the deal. And the other part is they are going to pay 19%, and we are going to pay nothing. I think it's a good deal for both parties. But we will have full access into Indonesia. And we have a couple of those deals that are going to be announced. India basically is working along that same line. We're going to have access into India. And you have to understand, we had no access into any of these countries. Our people couldn't go in. And now we're getting access because of what we're doing with the tariffs.
Morgan Stanley has reported that global oil inventories have surged by 235 million barrels in the past 5 months. But most of this increase is outside key pricing regions. However, only 10% of this increase occurred in OECD countries, which are considered critical for price formation. The bulk is in the Asia-Pacific, with China alone adding 48 million barrels. This uneven distribution is helping Brent crude maintain gains despite expectations of a coming surplus. Morgan Stanley forecasts a significant surplus after summer, projecting Brent at $65 a barrel in the fourth quarter of 2025 $160 through 2026. Oil prices fell about 1% on Wednesday as U.S. fuel inventory builds reinforced views in the market of shrinking demand as the wide economic impact from U.S. tariffs could curb consumption. Brent crude futures fell 1% to $68 a barrel. U.S. West Texas Intermediate crude futures were down 1% at $65.82. Safe haven gold prices rose on Wednesday, bolstered by persistent conflict in the Middle East and uncertainty over tariffs, while softer U.S. producer prices also added support. Spot gold rose 0.2% to $3,328.14 an ounce. U.S. gold futures edged 0.1% lower to $3,333.6. A Barclays analysis has shown that central banks and sovereign funds are significantly increasing their purchases of Eurozone government bonds in 2025. This move signals growing confidence in the euro and a shift away from U.S. assets. Official institutions have acquired 20% of Eurozone syndicated bond sales this year, up from 16% in 2024. With notable investments in German and Spanish bonds. This coincides with a 9% drop in the US dollar and a 12% climb in the Euro-Asian central banks are particularly keen, attracted by Europe's political stability, lower inflation and potential for ECB rate cuts. This suggests a rising appetite for euro-denominated assets amid US policy and currency uncertainties. Global markets showed mixed performance in Tuesday's trading session, with European indices posting modest gains, while US futures and Asian markets edged lower. In Asia, Japan's Nikkei 225 slipped 0.04%, while Hong Kong's Hang Seng Index fell 0.29%. The Shanghai Composite remained nearly flat, dipping just 0.03%. In Europe, the UK's FTSE 100 gained 0.2%, while Germany's DAX rose 0.27%. France's CAC 40 bucked the trend, declining 0.11%. The US markets pointed to a lower open, with S&P 500 futures down 0.42%, Nasdaq futures falling 0.44%, and the Dow Jones Industrial Average futures went down 0.4%.